Now this is really good stuff. 3 ways our money gets taxed: currently taxable, tax deferred, and tax exempt. So according to the 2014 tax tables, a joint return of between $36,000 and $73,000 is 25% on ordinary income. Ordinary income is the money you get from a paycheck. So anything you get from a paycheck is taxed. If you're in this income bracket, you're being taxed at 25%. Now, for the same tax bracket, on long-term capital gains, it's only 15%. Now, that just went up recently from last year. Long-term capital gains would be any stock or mutual fund that you hold more than 12 months and sell at a profit. And that's going to be taxed at 15%. Do you think those rates will go up? Absolutely. So a lot of times we have clients that come in to see us, and if they sell the stock, they have a really big profit. And what's their first concern? Oh, I got to pay a lot in taxes. Okay, would you rather pay tax at 15%? What if next year it goes up to 20 or 25% on long-term capital gains? You know, at some point, Uncle Sam is going to really get his share. And by the way, I have a secret. He's really not your uncle. They just call him that because it sounds good. So taxes are very important to our investments. So let's look at tax advantages. Let's look at tax deferred as opposed to tax exempt. A tax deferred example would be your 401k plan, your IRA. How many people have a traditional IRA? A lot of people. Or deferred annuities. So all the growth in those plans, you're deferring your taxes. When you start pulling it out, it's now taxes are due. So it's usually withdrawn as ordinary income. Tax exempt would be municipal bonds, or people call them muni bonds, a Roth IRA, or Roth 401k. Withdrawals are normally not subject to tax. How long do you have to hold the money in a Roth IRA before it's not taxable?
5 years.
5 years, very good. So you got to hold it for 5 years, and then you can pull it out of the Roth. So in our last class, we had a woman, and we kind of had a debate in the room. Should she convert her IRA to a Roth IRA? Well, do you believe taxes will go up? Yes. Do you believe taxes will go up? Yes. Do you want to pay taxes at a lower rate, or do you want to pay taxes at a higher rate? Now, if you have a $100,000 traditional IRA and you're in the 20% tax bracket and it costs you $20,000, well, that's a big check to write to Uncle Sam. But over the next 20 or 30 years, she's probably going to pay a lot more than $20,000. And I have calculators that I use to show my clients these numbers. And number 2, the example that I show people is, if your traditional IRA is worth $100,000 today, and you get paid taxes on that $100,000, or in 20 years, that $100,000 might be worth $400,000 or $500,000. You want to pay taxes on the $100,000 today, or over the next 20 years, pay taxes on almost $400,000 or $500,000. Wouldn't you rather pay taxes on the smaller amount? See, the government, and again, I talked about Social Security being a Ponzi scheme. The government with traditional IRAs and 401ks are really duping the American people, because you think you have $1 million in your IRA, but you're going to pay 40-50% of that over the course of your lifetime in taxes. So when you plan your retirement, you don't really have $1 million. So what this slide is showing is income tax deferral. So on a $300,000 investment, if you're in the 25% tax bracket and you're earning 5%, the net return, if it was tax deferred at the end of, say, 19 years, would be called $38,000. On a taxable account, it's only $30,000. So if I could do currently taxable or currently tax deferred, obviously the answer is I want to do tax deferred. So if I have a CD paying this and an annuity paying this, the annuity is tax deferred, the CD is taxable. Even if they're earning the same interest rate, I always want to go for tax deferred if possible. Now what this chart is showing is tax exempt compared to taxable income. and a federally tax-exempt return of, say, 4% in the 25% tax bracket is equal to a taxable return of 5.33%. This is another misconception. When I analyze potential clients' portfolios, a lot of them will have a tax-free municipal bonds because they think that, oh, it's tax-free, but based on their tax return, they would have been better off with the tax-deferred investment than the tax-free investment because they're earning less on the tax-free investment, but they're getting a better tax treatment. So when we really analyze the numbers, sometimes they don't need that tax-free municipal bonds. But here's something that's important. You might want to highlight this in your book. Place the most tax-efficient investments in taxable accounts and place the most tax-inefficient investments in your tax advantage accounts. So if I own a mutual fund that does a lot of turnover, when we analyze your mutual funds, some of them will turn over 100 or 200% in 1 year. That's very tax inefficient. So I want that in my IRA account because now I'm not paying taxes on it. Did everybody get that? So if there's a lot of trading in those mutual funds, put it in your IRA. Because you could have a mutual fund that you lose money on and it's still taxable because of the trading inside the mutual fund. It's almost like phantom income.